Hello there, Steve Cooney here, financial advisor, aspiring to be your retirement CFO. Welcome back to my video series where I'm going to share with you everything that I've learned over the last 25 years in creating effective retirement programs and how I was voted a top 100 retirement plan advisor by the Financial Times and Plan Advisor magazine. So our topic today is how much do your employees need to save for retirement, and how can we use the good old rule of 72 to help explain these financial concepts to them. But first, if you're interested in learning about the process that I use to create an effective retirement plan, feel free to check out my website at RetirementCFO.com. And also, if you're interested in getting a benchmarking on your plan and it's been more than 3 years, you can visit my website and also see off to the right here where it says Request a Proposal, and we'll help you out. So, back to our topic for today, how much do your employees need to be saving for retirement? So as a rule of thumb, we've always told folks, and this is one of the most common questions that's been asked at these employee education meetings that we conduct, but the magic number really is 10% of income. And that's really to give your employees a chance of being able to have an adequate retirement income. Obviously, if they started savings late, they're going to need to save more. Obviously, if they have other sources of income at retirement, they may be able to save less. But how do you determine how much income you're actually going to need during your retirement years? So in the business, we call this calculating your income replacement ratio. And on average, you're going to need between 60 to 100% of your pre-retired income once you finally retire to be able to maintain your standard of living. So for example, let's use a scenario of a 40-year-old earning $50,000. Let's assume that the 40-year-old, when they finally retire, their house is paid off and their children are no longer on their payroll. They've reached the American dream. So because these two large expenses are now gone, it's likely that he may be able to live on 60 or 80% of that income. So we also have to consider the impact of inflation on that. So according to the People History website, in 1960, a gallon of milk only cost 25 cents. Today, as I write this, the cost is more like $2.50, a full tenfold increase in cost. That obviously is showing the impact of inflation on the purchasing power of your dollar. So as consumer goods and services keep going up over time, your income is going to have less purchasing power to buy those goods. So what about this rule of 72? Basically, it's a simple math formula that we can use to estimate the effects of inflation or the growth rate of money over time. So first, here's the formula. Take the number 72 and divide it by an interest rate, and that's going to give you the number of years it's going to take for a dollar to double. So for example, if you're earning 8% on your money, if you take 72 and divide it by 8%, it would equal 9. So it would take 9 years for your money to double, earning an 8% rate of return. We can also look at this on the impact of inflation side. Take 72, divide it by a potential inflation rate of, say, 3%, 72 divided by 3, and we get 24. And that tells us that the purchasing power of our dollar over a 24-year period would be cut in half. So what we were able to purchase for $50,000, we're actually going to need twice as much money at retirement to have that same purchasing power. So back to our 40-year-old, income is $50,000, inflation is 3%. He's ready to retire in about 25 years. He's going to need $100,000 to be able to replace his income in the future. So bottom line is that these numbers can be calculated. Most of the 401k record keepers that we work with have the ability to put a income replacement ratio on the quarterly statement. Sometimes they'll actually calculate a future monthly income stream that they can get from their current retirement plan balance and projecting that growth into the future. So understanding and communicating these rules and calculations are critical in educating your employees so they understand these concepts. They understand the concept of income replacement ratio. They understand the impact of inflation on the dollars and how they can achieve financial success by doing some good planning up front. So if you'd like to learn about a valuable tool we call the gap analysis statement, simply send me an email, put that in the subject line, and we can send a sample over to you. But it's a tool that we use to help your employees understand how much money will they need, are they on track today, and what would they need to do to get on track. So I'm Steve Kuna. I'm aspiring to be your retirement CFO. Check me out at RetirementCFO.com, and I'll see you on the next video. It's going to be titled Optimizing Social Security Strategies. So thanks for watching, and you have a great day.